All right, so to begin, questions sent via email for our open discussion today from Mike E. It's very close to year end, and there's a sell warning on the market sentiment tool on PowerOptions. Is this the time to avoid new covered call positions? Well, let's head on over to PowerOptions. Let's review the market sentiment tool, the ways that Ernie and I and other members here at PowerOptions might use this tool for our personal accounts, discuss the covered calls and potentially alternatives if you fear the market is less than stable. So we're going to go ahead now and navigate over to PowerOptions. Fantastic. So here we are, excuse me, at the main PowerOptions screen. This is essentially a trial account that we're looking at. So if you're currently in a trial, you can take a quick tour. You might also want to scroll through the free webinars. You can schedule a free coaching session at any time as well. Now, Mike's question is related to this pod here and our various data pods, the watch list, basic market activity, stock gainers and losers, next live webinars, and more. The market sentiment tool is a collection of 13 broad-based market indicators that Ernie tested and went back historically to view to gauge signals of when the market may turn bearish, may turn bullish, may remain neutral. And he took those 13 indicators, applied them to different market conditions, and saw when a quote-unquote defenses were hit to indicate a bullish or bearish move. So we're going to go in depth here. Let's click on View Indicator Details. Oops, sorry about that, folks. And as you can see here, the market sentiment shows all of the individual components of that market sentiment tool. The put-call volume ratio, the SPX number of days up, SPX gap over the SMA 20, the percentage of stocks in the market that are over their SMA 20, percentage of stocks hitting a new 52-week high or low, the volatility index, the trend sentiment, the RSI of the S&P 500, the number of days SPX has been over its SMA 20 or its SMA 100, and the size of the gap over the SMA 100 or the percentage of stocks that are over their SMA 100, and a MACD gap as well. Now, every day this changes based on those that are falling into bearish territory, such as our put-call volume ratio, number of stocks hitting a new 52-week high or new 52-week low. Here, the number of days the number of days S&P 500 is above its 20-day moving average, and the percentage of stocks that are over their 100-day moving average is pointing to sort of an overbought S&P 500 and overbought stocks in the market. When I click View Overall Sentiment History, this shows us a collection of what we saw in the past. Yesterday, we were at 3, 9, and 1. So we had 3 bearish indicators, 9 were listed in the neutral field, and 1 was bullish. We had 2 sell warnings recently on 12.17 and 12.18, as high as 5 on the bearish and 8 on the neutral and no bullish. We've had some other neutrals in here as well, and then a collection of sell warnings that were popping up around 12.3, 12.5, and 1 bearish sell that popped up on 11.24. And I feel this is important. The strong bearish sell warning, 7 bearish indicators, 6 neutral, and no bullish. And SPX was topping about at 6.365. It did drop slightly, but then moved back up into new realms with some easing here, letting off of the steam of the market. And it is going down in a sense, very slightly, but it has hit other highs since that bearish sell. Why am I focused on this one here? In general, although we are seeing a collection of sell warnings in a row, the trigger that I typically use is for a bearish indication using the market sentiment tool, meaning that I may look to start preparing to manage some of my bullish positions, bull put credit spreads, diagonal calendar spreads, selling calls against stock positions that have an unrealized gain, buying puts more likely against stock positions that have an unrealized gain, or maybe selling calls near the top on my married put positions. I usually do that when I see, going back here, there's 2 light buys for us, when I usually see 2 or 3 bearish sells in a row. Although we've had a wide collection of sell warnings in a row, Mike, this is usually my trigger where I pause, look to manage my existing bullish positions, protect my existing bullish positions, cut back, or maybe hesitate on opening new bullish positions when there's 2 or 3 of these in a row. Is it accurate? Well, these hit around 824 and 825. And although it wasn't a major downturn, remember, in September, for about 3.5 weeks, we saw almost a 10% decline, about an 8% decline on the S&P 500 and across the market. Then we started to see the light buy, near the bottom, when we got down to that 3,200, 3,236, and 3,246 range. We were pegging out at 4 bullish indicators and no bearish indicators, with 9 neutrals as well. That's how I use this tool. This bearish sell warning is a little bit of hesitation for me. Okay? But after the recent neutrals and then some sell warnings, I'm still leaving open, I should say, bull put credit spreads, calendar spreads. I just opened a new married put today, and I'm considering selling a call against it if it moves up tomorrow or if it moves up on Monday as well. Now, all that being said, is now the time not to do a covered call position. I've got to go into the other strategies right now simply because I don't have covered call added into my screen, my available tabs. So let's save that configuration. Now we can go into covered calls. Mike's concern is opening new covered call positions, probably targeting maybe a weekly return of 0.7, 1%. Or maybe he's going 2 weeks or 3 weeks out looking for maybe a 1, 1.5, or 2% return, or maybe going a month out, maybe looking for a 2 or 3% potential return if assigned on covered call positions, but worried about the market pulling back as we all are. Now, I've told you how I use the market sentiment tool. Right now, I'm not in hesitation mode because I haven't seen those 2 bearish sell warnings in a row, even though I am seeing some of the sell warnings and consistent sell warnings, but the neutrals are coming in as well. So it seems like that pressure is easing off, but then it wants to go back up. Might be a good time for a little bit extra protection if you're doing covered calls, meaning looking for covered calls that are slightly in the money for a higher downside protection, but still a reasonable percent return if assigned that matches your trading plan. All right. Now let's just go into the search here. All right, and that's a weekly pick of the day, but what I'm gonna look for is just the in the money default screen. Okay, so now these might be a little bit too much for me when I wanna adjust some of the criteria. But just in a case like Car Gurus, the stock is trading at 33.27. January 28 might be too deep in the money for me, but it is still offering a 1% return if assigned with a 16.7% downside protection. Some of these here are 2% return for that 23-day trade, still offering a 15, 16, 17, as high as almost a 19% downside protection, meaning the stock can fall 15, 16, 17% before you're technically losing money on the position. That's another way to approach it, is to find the stocks, identify the stocks using the search tool that match your criteria for the stock fundamentals, the stock technicals, and then maybe shy away from the original return you were looking for with an at the money or maybe slightly out of the money covered call, Mike, for more speculation, more potential appreciation, I should say, with the out of the money covered call, and scale it back to look for a higher downside protection with still a percent max if assigned that meets your targets if you're expecting a downturn in the next 20 to 30 days. If you're worried about the market sentiment tool, add some extra protection by going deeper in the money. My personal preference is that if I'm looking for income strategies that are 2 weeks out in time, 3 weeks out in time, a month out in time, and I'm using the covered call or the naked put strategy, but I'm concerned about a downturn, what I'd prefer to do is open the position as a long collar. I buy the stocks that I'm interested in, that match my criteria, that for the shorter term, I'm looking to generate a 1 or 2% premium, again, 2 weeks, 3 weeks, 4 weeks out in time. but I'll still buy an out-of-the-money put option to take away from some of the upside, but still give me a max 1.5% to 2.5% return, but guaranteeing that I can't lose more than 3 or 4% in that 2, 3, or 4 week period. The put gives me a floor. Yes, I'm taking away from some of the upside profit, but it's to minimize risk in case I'm wrong, in case some unexpected news comes out, or in case we start to see bearish sell warnings after I open the position. I know I have protection in place that is guaranteed. So what would a long collar structure look like? Let's just go ahead and go to our search. And it'll probably come up with our default initial value screen, but we might make some changes to that as we saw before based on our current goals. This one is not too bad. I'm going to change this. We're going to go straight, Mike, to the standard January expiration, 23 days out in time. Excuse me. We're going to keep our call and put with the same expiration date. That's the true collar, true standard collar. Okay, so let's submit that just with that change. Okay, this one's not bad at all. Not saying this is a good stock because I'm not looking at the stock chart or doing any analysis here. But the first one that comes up is a stock trading at 27.01. We could sell the just at the money January 27.5 strike for $1.63. This put I feel is too close. Buying the January 26 for a midpoint price of around $1.45. We'd get a net credit. Still taking a net credit of this position of 34 cents. But now the maximum risk is only 2.5% if the stock drops below 26 between now and January 23rd. If it stays above 27.5, I'm still making that max return of 3% that I might expect with a covered call. But I can't lose more than 2.5% even if the stock or the market reverses and drops 4, 5, or 6% in the next 23 days. This isn't a bad structure at all. Do not get me wrong. I just think we're taking away too much premium by being this close to the strike price. I might want to allow the risk to go up a little higher, to 3, 4, or 5%, which is a guaranteed exit, much better than a stop order in case the stock really crashes. But I still want to be able to achieve that 3 or 4% return, 2 or 3% return, and we see we're still able to get that. The DHI one, I'm not liking these strikes. This one's almost perfect. I don't know the stock. The structure to me is almost perfect. I really like it. MGA, Magna International, trading at 72.35. Of course, it's up 6 points today, so that might cause hesitation based on the news for that. We'd want to do our further research and analysis to see what caused that movement on the position. Selling just an out-of-the-money 75 strike for $3. Buying a 70 strike January put to get a midpoint net premium of 38 cents. Max return if the stock goes up to 75, 4.2%. And a max risk if it falls of only 2.7%. I'd be really interested to see if there's a 72.50 available on this particular stock. It would have come up. But let's take a look at the profit and loss chart very quickly. Okay, so you're looking at maybe a 35, 40% probability of being assigned in this case. It has to go up to 75. You're going to get some appreciation. This is a good risk-reward ratio for a standard collar. However, what I wanted to look at in the options for January, there is. Let's take a look. I want to see what the 72.5 and the further out of the money 67.5 strike is. So maybe we pay $1.85, and maybe we get 4 or 4.05 here for better upfront premium. Maybe not as high as a percentage return, but still a very controlled risk, just bracketing the stock with the at-the-money call for the most time value and keeping out of the money with a 67.5 strike put. Okay, that's almost a 1-to-1 ratio, risking a little bit more at 3.8% and not making as much, but with the stock at 72.35 and selling the 72.50, we've got about a 50-50 chance of making that 3.3% in 23 days. And in the worst case scenario, we're only risking 3.8%. And the stock has to drop to 70.15 before we start losing money on the position. This is a structure I really like. close to 1-to-1 risk-reward ratio, 50-50 probability of making the max return for the standard collar, still controlling the risk for 23 days to only about 4% on the trade, and less than 4%, excuse me. I think this is a good structure. Now, I'm not saying MGA is a good stock for neutral to bullish position over the next 23 days. Again, I do that further research and analysis on the position, but this is an alternative to trading covered calls if you fear that the market is in a decline or the market sentiment is entering into those sell warnings, and if the bearish sells start to approach. It's another alternative to use when you're fearful of the market trading those covered call positions, Mike. So again, we talked about how we use the market sentiment tool. We're usually going to look for those 2 bearish sell warnings in a row where we might start managing our bullish positions, cutting back on new positions, adding protection to existing positions. But if you are concerned and you feel now is not right time to do the standard covered call approach you're doing, you can increase the downside protection for your covered calls by going more in the money and still keeping a good % return if assigned, or take a look at that long collar approach to control the risk for a shorter period of time, and at the same time, still target that 2-3% return you're looking for 20 or 30-day trade. Okay? All right. Okay, so that's for Mike, and we're going to jump into Maurice's question now. And it's just a broad question. It's not really a strategy question. And then we've got Mark there next. Okay, so Maurice asks a simple question. Does naked put on PowerOptions, when we show naked put, does that mean a long put or a short put? Naked put or naked call, Maurice, means selling the put or selling the call. Short put or short call. Okay? It's naked because you're selling a put option without another put to protect it, or without being short the stock to do the opposite of the covered call, of course, in that case, which would be the short put position. I'm sorry, not the short put position, the covered put position. Let's take out long put for now and let me add in naked put. There we go. Okay. So when we say naked put, we're referring to selling a put option against a stock, typically out of the money. So the naked put or naked call we could consider to be short, as in sell, or selling a put. This is also sometimes referred to as a cash secured naked put because you may have to put up the full obligation to potentially buy shares of stock, Maurice, at the short put strike price. So terminology we use is naked put, referring to shorting or selling, or the naked call position. When we say long call or long put, we're referring to buying a call option, speculating that the market is going to move up. And of course, we're looking to profit on the leveraged gains on the call option if the stock moves in our desired direction and our desired sentiment as well. Although you could say that buying a call and buying a put also means uncovered, in the sense that you haven't sold anything against it or you're not in a straddle, the naked refers to selling the put, selling the call, or what you might say shorting the put or shorting the call, because you're not protected by another instrument that can hedge losses to the downside in the case of the naked put, or the technically infinite risk to the upside on the naked call position. Okay? Now, if I buy an extra call one way or the other against, say, this naked call position, I'm either creating a bear call credit spread or perhaps a bull call debit spread, where our sell option would still be here, but now we have something covering it, so it is no longer technically naked. Or if you own the stock, that was the covered call strategy we just discussed a little bit for Mike as well. All right, so that's the terminology there. Naked means short or selling, Maurice. Long call, long put, that means buying. So now there's 2 ways to access the webinars. Let's go back to Mary Put. Maurice, to access the recorded webinars, many of them are available in the free webinars section. These are related to the PowerOptions tool. So we haven't covered a full tool, for example, recently since about September. Going into the full, we just covered the market sentiment tool in the beginning. There was one here from August 21st. There's one from 12/21 and from 11/3 on the option strategies. This is a public page, by the way, PowerOp.com/webinars.asp. So you can check that out there as well. Now, there's some on the options concepts. Look at the stock repair tool and requested topics. We've got some from 12/19, the one about the collars that we talked about a couple weeks ago, market sentiment, and a new portfolio feature as well. So today's discussion, we talked with Mike. Hey, I'm probably going to put that in the option strategy section. The one we just had about the married puts and the income methods, that's probably going to be posted maybe at radioactivetrading.com. Oh, sorry, 1 second. That's Return to Radioactive Trading under what's called the free webinars area. Okay, but all of videos, Maurice, are posted on our YouTube channel. If you go to YouTube and just screen for Power Options, you'll see all the different webinars. Here's the one from last week: the risk rewards of weekly covered calls, adding a put to a covered call structure to create the collar, tips on exiting a bull put credit spread. That was from last Friday's discussion, the short straddle discussion from Octavio. Here's the proper protected structure, an in-depth look at the proper structure of the married put, showcasing the RBA trade we just discussed, which we posted for our Fusion subscribers right after this video was done and posted. So there you can see all of the Friday sessions, all of the cropped and cut videos, Maurice. Just go to YouTube, search for Power Options. You'll see our icon there. You can scroll through our most recent videos. And of course, as always, if you have a YouTube account, you can view this for free. They're all public. All the ones you're seeing here are public. But if you are a member of YouTube, you have a YouTube account, just make sure to subscribe to the Power Options site. You'll receive, of course, that notification when we post any of our new videos, whenever we post any of our new videos. Well, I just wanted to remind everyone, of course, today that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations, trade recommendations, or trade suggestions. Options do involve risk, as we saw today. The market itself involves risk, as we discussed today, and it may not be suitable for all investors. Now, if you liked what you saw with some of the tools, we focused on the search tool today. We focused on the different strategies using the custom spread tool or profit and loss chart to run what-if scenarios, as well as to run different examples. You can test out the Power Options tools at any time. Just go to PowerOp.com, put in your name and email address. You'll have full access to the tools for 14 days. The search tool, using those research and analysis links we looked at, the portfolio tools for tracking and managing, plus the virtual library of options education, and much more. The subscription level started just $45 per month after that free 14-day trial. No credit card is required, I should have said, for the 14-day free trial. Subscription level started only $45 per month. We offer different levels of service for delayed data, only 15 minutes delayed or so. That's $65 per month. We do, of course, offer a real-time service and access to our full historical testing. We just looked at that one little historical test today, changing the date on QS from yesterday to today, or today to yesterday, as it were. Reminder, of course, we talked about the married puts. We talked about the protection for long-term and the proper structure a little bit today, leaving the upside open rather than trying to force income to generate on a consistent basis. And for Mark, we talked about the decision-making process of the income methods. If you pick up the blueprint, that's the full course that discusses the radioactive trading techniques, that proper married put structure, what we look for. There is such a thing as taking too little risk and the improper structure as well, but you'll be able to lock in these 8 special bonuses whose monetary value actually exceeds the cost of the blueprint. You want to see more about that, go to radioactivetrading.com/EOY, or you can just go to radioactivetrading.com and click the products tab in the top corner. In addition to that, for Maurice, of course, we talked about the free education. You can visit the archived webinars page at any time. It's powerop.com/webinars.asp. It is a public page, but some of the more recent presentations are only available to Power Options subscribers. But of course, you can go to YouTube, as we showed Maurice, search for Power Options. All of our videos, most of our videos are posted there to the public, except for members-only webinar special presentations and some of the unlisted presentations that are there as well. But there's a lot of information, and you can even search just on YouTube on our channel for covered calls, market sentiment, collars, and you'll see a listing of the videos. I tried to be as diligent as possible as keeping the strategy that we're discussing in the title of the webinar or the video that's posted to YouTube. So you can just search for that and you'll be able to find all the videos on this particular strategy as well. Ladies and gentlemen, thank you for joining me for our special Hump Day Wednesday afternoon open forum Q&A session. If you think of any questions later on, send me an email to support@powerop.com or support@radioactivetrading.com. Remember, you can call us during market hours at 302-992-7971. Any trial member or subscriber can also schedule a coaching session at any time. That's a free 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. I will be honest with you, I don't think there's going to be a wide amount of coaching sessions available next week due to the holidays. I do have 2 tomorrow morning, but of course none on Friday and none Thursday afternoon. And I'm not sure what Ernie's schedule is, but my schedule is limited next week for the coaching sessions. But again, you'll be able to find it. If you can't find it scheduled time, send us an email. We'll try to work something out as well. Take care, everyone. Remember, markets close tomorrow at 1. Do your rolls or adjustments before then. Have a happy holidays. Stay safe. Wear the mask, of course. Wash your hands. Stay healthy, most important. Enjoy the time you can with your family members. Have happy holidays. Merry Christmas. We'll be seeing you soon next week for other presentations. Our next open forum will actually be, as I mentioned, next Wednesday on the 30th, because the markets will be closed on Friday due to New Year's Day. Good night, everyone. Take care.